Hey everyone, this is Adam Cochran from Cinemain Ventures. I was invited to do a Sushi AMA on the current fundraising that Sushi's going through, but wasn't able to make my time slot. So I wanted to take a few minutes to record some of the questions that I've been asked by members of the community, both on Twitter and on Discord. Before I start, obviously none of this is financial advice or forward-looking statements, and it's just opinion, and I encourage you to question those opinions and seek out other perspectives, because I'm sure there are a lot of smart people who disagree with my perspective and approach to things, and you should always take kind of a balanced perspective on that. So the first question that somebody asks is like, why should Sushi raise any money at all? And there's a few different reasons why you want to raise capital kind of to accelerate your growth. Some of those can be strategic value from the funds themselves. Some of it can just be having capital that's in a diverse war chest where you're not worried about having all of your capital locked up in your own token. And the third and most important one, which is why most startups raise money, is to kind of fuel growth when they've got a very compelling market to capture. And in later questions, I'm going to break down each one of these in much more detail, but those are kind of like the high level perspectives as to why you would ever want to raise money. So that leads to the obvious follow-up of, does Sushi actually need to grow more? There's a lot of people who look at Sushi right now and say, Sushi is a successful DeFi company. Sushi has already grown a lot. It doesn't need this accelerated growth. When we look at Sushi, it's got this market cap somewhere between 1.5 billion and 2 billion, depending on how you want to calculate it with fully diluted. And we can debate if that's under or overpriced. But the most important thing is that we can all agree that crypto is still super early and growing. If we were to compare that to something like the New York Stock Exchange owner, Intercontinental Exchange, they're valued at $68 billion right now, which is, already this 30 or 35 times multiple of the market cap of Sushi. When we're talking about crypto markets, however, and crypto exchanges, we have the opportunity to reach 100 times more people than the Intercontinental Exchange. Not only because things like SushiSwap can have a diversity of assets that we don't currently have traded on stock exchanges, but also because the Intercontinental Exchange primarily has exchanges that are larger investors, mutual funds, and very Western focused, highly concentrated in the US, Canada, UK, parts of Europe. That's not what we're seeing in decentralized finance. We're seeing this accessibility for everyone in every user class all over the world. So when we're looking at this once in a lifetime growth opportunity, there's a market out there that is easily arguable as being worth 50 billion to 500 billion. Sushi is obviously one of the leading decentralized exchanges right now. We can debate if it's first, second, or third, but we know it is a leading contender. So why, when there's this opportunity to have something that is worth 50 billion or 500 billion in a once in a lifetime, possibly once in a generation shift, would somebody stop trying to grow just because they're 1.5 billion to 2 billion? So there's this outsized 100x opportunity here that somebody is going to capture. And it's compelling that it should be SushiSwap. Another question that we have a lot is, aren't VCs bad? Yeah, some suck, right? In the crypto community, we have this problem of lumping every type of fund and every type of rich investor and institutional investor in as a VC and just calling them VCs. This narrative seems to start recently, and I have genuine concerns that it's trying to divide crypto users from one of its biggest supporters. Bankers and regulators, they really like the status quo, and they've done a number on traditional financial systems. We've got hedge funds out there like Citadel who are involved in the whole Robinhood GME scandal. We had all these investment banks that did the subprime mortgage meltdown. We've got investment managers like BlackRock who are out here buying up every single American family home so that they can rent it back to us. Those types of funds who are very focused on these short-term financial gains, they're very interested in keeping the financial system the way it is. VCs, at least most of them, those who are doing it correctly, have always been pro-lockup, and they were the first investors in the crypto space. When funds were saying things like, crypto is this disruptive criminal organization, it was venture capitalists who were helping to fund some of the first crypto startups, who were paying for lawyers to help defend those crypto startups. as well as supporting lobby groups like Coin Center. If you go and look at Coin Center and see who it is that's on their roster, it's a lot of these well-known VCs. Meanwhile, these investment groups, they donate to different political campaigns like Representative Brad Sherman, who we saw in the recent hearing about crypto, who was saying that, crypto is only a thing for drug lords and that drug dealers love it. It's as if we printed a $10,000 bill. If you look at some of the names that are some of the bigger donators to people like Brad Sherman, it's not those VCs who are funding Coin Center. It's places like BlackRock, CME, Goldman Sachs, NASDAQ, Vanguard, people who would have a pretty vested interest in keeping the status quo of the current financial system. Now, does that mean they're all out to keep status quo and to divide people? No. Does that mean all VCs are good and useful? Hell no. Some VCs are bad. Some bankers and investment bankers are good. Some liquid funds are bad. Some are great. It's not clear cut. The danger becomes whenever we just label this group holistically and decide it's a problem. And I'm not sure exactly where this conversation came from, but it did spring up quite recently and is quite visceral, and you have to be able to question some of those assumptions. So I think it's fair to say there's a lot of VCs out there who are bad. There's some who are really good. What should a good VC do then? So VCs are supposed to be investors kind of plus consultants who are experts in one thing. In many countries, especially in the Commonwealth countries, the exemption for VCs under securities law is not for them to be a passive investor, but it's kind of based on the idea that they will apply their expertise in one sector or one type of value add, and they will leverage that to help not only invest, but to make money and a return. So usually these large, more established funds are less hands-on. You kind of pay a premium for their expertise and their contacts, and they're usually very, very good at helping you hire senior individuals. They're helping you get the right lawyers, get in touch with the right regulators, have a tremendous amount of contacts, but they're also good at scaling these multi-billion dollar companies. When we look at a large former startup like Coinbase, running an organization of that scale is actually very complicated, and there's very few people who have ever had experience in doing that, and having the contacts and having the network to support that is very valuable. On the other hand, you have smaller funds who usually have a very specific specialization. A great example of this in the space right now is, Paradigm, who is some of the best at research on new DeFi mechanisms and security and solving those problems. So there's a number of things that top VCs should be helping with. They should be helping to explore novel mechanic problems in either the product or the governance side and how we organize those, because those are new and unique challenges. And it's valuable to have smart people who are thinking about those every day. Helping to evaluate a competitive roadmap. Far too many startups get product creep, and especially excited founders start to take on too many challenges at once, and having somebody on the outside who can help really pare that down, and because they understand deeply one specific segment of the market, is useful, and helping to prioritize the team's attention in that same way. They also give great access to their portfolio companies, and I think that's something that Mackie has been really interested in, is getting access to these early stage investment opportunities. Because with large funds, they're usually the ones who are the very first pitched whenever a new project is starting up. So it gives you an opportunity to say, hey, with our MISO product, where there's an auction going on to raise your tokens, we want to make sure that each of these portfolio companies are getting onboarded through MISO. They can also intro you to partners and customers. That happens sometimes. That's more in traditional VC, probably less in the DeFi space. They're also very crucial in hiring. A lot of key executive hires are individuals who are working at companies or solving that specific problem in the space right now. They're not out there looking. They're not interested in floating around a resume. They're not applying to your job application. And they can be really hard to peel away. They can be especially hard to peel away for an anonymous DAO-based project, where they might perceive that as greater risk than their stable job with an American corporation. Having a VC provide that added value, provide that introduction, and that sense of confidence in this opportunity can be a big deal for some of that hiring talent. Lastly, they're kind of crucial in those fights with regulators. A lot of these VCs who have been around in the space and built up their name have deep relationships across regulators, across government entities, across lobby groups, and they can be really valuable in helping make those introductions, having those strong conversations, and sometimes even tipping the scale. I think SBF said it really well in one of his tweets that when you have the right VCs, they will fight for you broadly across the category because their interests are aligned. Because they are locked up, because they are on this journey with you for a number of years, they are not going to drop you at the first sign of trouble. They have to fight because their outcome is tied directly to your outcome. More importantly, people think that VCs are all one type of user class that are going to vote the same way. And that's simply not true. I can't find a group that you can put an individual label on who disagree more than VC funds. They're going to take different positions. They do not agree with each other across the board. Right now, I think if you looked at it, you'd probably find that 20 to 25% of the sushi voting power is held by somewhere between 3 and 5 entities. Arca alone says that they own around 7% of all X sushi. Now, this isn't necessarily a good or bad thing, right? We may trust the judgment of those individuals. We may think they're doing a good job in exercising that governance right now, but it also isn't diverse and decentralized. And it's really hard to do good decentralized governance when it's small users holding all of that apart from a few concentrated positions. Because that means that these small users have to convince hundreds of other users before they have the same kind of political clout that one entity does. So many funds have people's full time focused on being up to date and deeply involved in the governance of their portfolio companies. And I think that when you have a diverse group of stakeholders who all have a larger vote, it's much easier for them to help keep one another in checks and balances. So if you're going to have large funds and large entities involved in governance at all, it's probably for the best that there are a few that are along a different type of spectrum, different types of funds, different goals, so that they have a diversity of perspectives in keeping one another in line. So what type of investors does Sushi need? The type that Mackie seems to want the most at this stage is strategic partners. And that's from the post on the Sushi forum. I'm not trying to put any words into his mouth, so I encourage him to express it additionally if he thinks I've done him a disservice on this one. Uniswap has a great VC network, and they took this opportunity in the launch of V3 to create a closed source approach where there's a licensing restriction on the product. Sushi's Trident, however, is open. It allows you to build tools that can capitalize on new AMMs by having them integrate as a Sushi standard pool and be involved in their router, as well as farms and through new projects that are launching on Miso. So there's VCs out there who have massive portfolios and they spend far less time on each individual startup, but they're a great opportunity to offer up that portfolio because they see it as part of their ecosystem. And they're going to drive new individuals into that ecosystem. They're going to look for partnership opportunities. They're going to try and find a way that they can get a slice of this lucrative AMM model, especially if they're not part of Uniswap's ecosystem. I think that putting all your eggs in one basket there, from my perspective, would be a mistake. I think that there's probably a blend of type of investor that Sushi wants. They probably do want some with large portfolios. On the other hand, they probably want some who are active operators in the space who have small portfolios and can be deeply involved. And then my personal opinion is that they probably want to look for some who have very experienced product and hiring rigor that can kind of help level up Sushi to that next professional level as they grow. One of the common questions that we hear is, why do investors get a discount? And they don't. They are not getting a discount on Sushi. I think it's a bad framing, and it could come from kind of dividing users against VCs. And so I think a great example of this is to use something simple like Pokemon cards. If we imagine that there are two Pokemon cards for sale, there's a Charizard A and a Charizard B. Charizard A can be unlocked today, meaning you can trade it, you can use it in matches, and it is one Charizard out of 192 in circulation. You're going to pay 300 today. Then there's Charizard B that somebody is selling. It's going to be locked in a vault, like a physical vault, for 3 years. You cannot use it, you cannot trade it, and by the time you get it out of that vault, it's going to be 1 out of 250 in circulation because they're going to print a few more. That one is also selling for $300 today. If those were the options in front of you, which card would you pick? I think it's safe to say that when we lay it out like this, we can see that these are not the same asset. They're both a Charizard card, but they have different attributes about them. So thinking of Sushi and locked Sushi that a VC is buying in a restrictive covenant contract, they're going to be different assets. Right? Funds who are open to dilution or some that are anti-VC would love you to compare them as the same. Right? Users who are adamantly against VCs would love to compare these as the same, but they're not apples to oranges. No one is getting a discount because they are a VC. They are paying a different price for a different asset that is locked up and has a different amount of total tokens when it locks. Right? And I think anybody, VC or not, who is eligible to make that purchase deserves the discount for the different asset, right? It's a different priced asset. The question becomes, can you sell that second restrictive asset to consumers? And, I don't know the answer to that question. That's something best deferred to legal experts. Um, Somebody literally sent me the question of, but some VCs suck, right? Yeah, totally. There's a lot of dumb money out there. There's a lot of dry powder. Some are 99% not useful, but have this like one attribute about them that when you need it, you really need it to call on them. Others are liquid funds who call themselves VCs and dump on you, right? At the same time, there are some liquid funds out there who are some of the most useful and supportive VCs in the space. So you can't even look at it in that way. A lot of these projects that people have referred to as VC money grabs may benefit the teams or other early investors. But most VCs are willing to commit to long lockups because a VC fund is often close-ended and structured with this 5 to 10 year return time. So VCs are actually more patient and aligned and less likely to be dumping than other entities out there in the space. At the same time, there's a bunch of VCs who do suck. There's a bunch of them who will absolutely sell on you just to make a buck. And it's really hard to tell who sucks. So all you can do is kind of look at the actions that you've seen so far, have them make a case, and I think see where that case is compelling. Somebody asked, aren't the things that you're arguing just in favor of you as a VC? Yeah, totally. I'm a new VC. I have self-interest here. Some people have argued that my involvement with Sushi is entirely self-interest. Yeah, it is. Everyone's involvement with Sushi is self-interest. Whether that's you're here for financial return, you're here to protect a governance stake you have, even if you're just here for the validation feeling of being part of something larger than yourself, everybody has self-interest, and that's what's motivating us to take these actions. There's a difference, though, in that some people in funds will tell you what their self-interest is, that it exists. They'll even weigh it up in the interest of others because they understand that the value of respecting the interests of others and that character is important, or even they understand the economic case that if we can create this kind of equilibrium of values, we are going to go farther together as a space than tearing each other apart for a nickel and dime here. And there's also people who are going to tell you the pros and cons of their proposal. Others will tell you that they're an answer to your prayers and sell you out for $1, right? It's a total sliding scale. And I think it's important for us to consider in DAOs. Everybody, including general users, is here for their self-interest. It's just a matter of how willing to come to the table and accommodate others' self-interests are they, and how transparent are they in those self-interests. I spent a lot of time with Sushi in the beginning when Nomi left, putting aside my own self-interest because I believe this is better for the space. If something as large as Sushi was when it launched was to collapse, that sets DeFi and blockchain back years. So even though I in fact refused to take any financial compensation for my time involved there, it still benefited me because the space as a whole didn't have this huge collapse event that would have set back the adoption of DeFi even further. And when we can lift each other up, other protocols, other individuals in this space, it is going to allow us to go a lot farther. And this space is so potentially huge that this rising tide is something that lifts all ships. So if you can see that, you can understand from the perspective of being willing to set aside some short-term self-interest to enable the larger picture that's here. And I think that's an important question to be asking the types of VCs and funds and general investors that you want to include in any type of DAO. Somebody asked, should Sushi sell Sushi tokens at all legally? I'm not a lawyer, not going to give any legal advice. The security counsel in this space I trust the most, LexNode, aka Gabriel Shapiro, he pointed out in the governance forum that there's probably some level of risk here, whether it's to the public or VCs. There's probably also alternative models, whether that's debt assets, a Sushi Lab holding company that does equity raises, or other items that are expressly securities but done as part of some exempt offering that can be explored. But that's for the Sushi team to decide in collaboration with their counsel and take the right approach here. DeFi is in the crosshairs. There are agencies out there that would love an excuse to go after DeFi. And I think it's important for every DAO to act in good faith and try and take the legally risk-averse opportunities that are in front of them explore these well, and understand that a lot of the regulation that exists is aimed at protecting people, because people do get burned in this space. And as much as we hate the restrictions on regulation, and as much as we hate that it is very outdated, there is good reason for some of it existing. So I don't have the answer to this. It's obvious that there is some level of risk anytime you involve, especially the US market. And so that's something for people to weigh up. Somebody asked, is the raise amount too high? Perhaps. I think overall it's kind of in line with what you would expect a company at this stage, the stage that SushiSwap is at, to be raising in traditional VC markets. And the reality is that unless we figure out a streamlined way to fundraise in DeFi, fundraising continues to actually be a tremendous amount of cost, mainly in the effort of your senior staff, involving legal, doing all the paperwork. That absorbs you away from working on the product, which is a waste. So usually you raise a high amount so that you don't have to go raise money again. And the later stage the startup, the longer they try and stretch that runway. 60 million isn't too bad for this stage. If I saw that in a traditional startup, though, I'd probably want to see a much more robust breakdown of planned capital allocation, and I would expect more sophistication from a financial department in terms of like where money is being spent, how long the budgeting is going to take, where it's going, what runway it enables, things like that. And I would expect a compelling growth story that says, hey, we're going to allocate X amount of dollars to capitalize on outcome Y. So it is on par. Not too high, could be a little lower, but if you're going to go for that amount of money, it should be a little more clearly laid out. What would I spend the money on? Somebody asked. Hiring experienced exec talent seems to be like a great opportunity. It's very low-hanging fruit. Sushi's product goal has it kind of pursuing these mainstream cross-chasm users, at least down the line, because they have this expertise in building across an ecosystem and these beautiful UIs and moving very rapidly on new opportunities. But it's becoming across a broad portfolio of products. And I think these cross-chasm mainstream users expect a more polished product along the lines of a Coinbase. Somebody said that Sushi is competing with Coinbase. I don't think that's fair. They're very different products and very different outcomes. But we do have a fractured product portfolio where there's still some long-lasting bugs and oversight. We have got multiple domain names pointing into different directions, multiple info stat sites. There's a lot of things that you can kind of iron out with that senior level capacity talent, hiring more engineers to execute on that opportunity, but also making sure that if you're going to go into this product market where you have a large suite of products, you have very experienced product managers and leaders who are dedicated to overseeing each one of those resources and making sure it gets the attention it needs to grow, as well as somebody who's in charge of making sure their representation is cohesive. So I think there's a lot of potential for Sushi to level up some of that senior talent, hiring engineers to go after the opportunities they want to capture, and that senior product talent to kind of tie it all together in a smoother user experience. Then I would posit that there's probably investments to be made in growing out some sort of BD partnership team, because Sushi really is going to benefit from people adopting Miso, from people getting involved in onsen, and providing additional rewards to the liquidity pools that they have. And that's a lot of deal making. That's a lot of time spent on product sales. And you would expect quite a large team for the opportunity that they have to capture there. So some of the other questions are around Smaug, which was a proposal I put forward around a way for Sushi to facilitate the raise. And it's basically a way to take this opportunity that Sushi has and productize it, because there's a lot of DAOs out there who are facing the same challenges of wanting to raise money, create a diverse treasury, sell assets in a compliant way. And so Smaug is basically a protocol and marketplace that allows you to create a functional debt instrument that called an S-bond. And it's very similar to convertible debt. And convertible debt is a popular tool that you would use to invest in later stage, sometimes very early stage startups, where basically the startup is going to take a loan of something like 10 million US dollars from a VC or fund, and the expectation is that that debt at a future date gets turned into equity in the startup, and usually with a baked-in discounted rate to account for the fact that it is this locked time asset. So if a startup was worth like $2 million today, but $10 million tomorrow, the debt is converting at the 10 million minus the discount. So this allows startups to raise money when they need it, but to get better terms based on the valuation in the future rather than today. There's not a clean way to do that on chain, and most convertible debt doesn't have a payback opportunity, not in the same way as we think of a collateralized position on chain, meaning the startup is kind of out of the upside regardless of how well they do. So with Smaug, the S bonds are kind of different. The Sushi could set a term of issuing $1 million of S bonds, putting 1.25 million of Sushi as collateral in the bonds, and setting a really high APY on the debt, such as like 50% a year. Each year that debt of the million is going to grow by 50%, and that's kind of prorated right down to the individual block level. But Sushi has the right to pay part of or all of that debt back over time. If they do pay the full debt back, they get the collateral back. If they don't, then the VCs get the collateral, but all the remaining debt is forgiven. Somebody asked, doesn't Smaug mean that there's capped upside for investors? To an extent, but not really at the end of the day. So VCs normally want this uncapped upside because of kind of what we call the VC money ball, the math in a VC fund where they know that 9 out of 10 startups they invest in are going to go to zero. And in traditional equity, when a startup goes to zero, it is literal zero. There's nothing to sell. And so for the math to work out, they actually need one startup to do like 100x to win. But in tokens, things don't really go to absolute zero. You know, you've been able to buy and sell BitConnect tokens for long after BitConnect even stopped being a thing, and there was still this thin market for it. But even if something performs badly, it doesn't go to zero. So this actually changes the VC math a lot. And if you look at the average annual return of VCs, it's a good VC return is like a 3x over this 10-year portfolio, which would, you know, be considered poor for crypto portfolios nowadays, but more broadly, that's what it is in the marketplace. And you can kind of average that out to like this 12% APY minus fees each year. And the portfolios are needing to achieve that overall goal. So when we talk about that in the crypto space, that's not a huge APY. And with the S bond, they kind of had this binary outcome where they're getting double-digit % returns on their USD, possibly triple-digit, or they get the token that's underlying it, which would have grown. Startups can price that APY on their S bonds competitively and should, because it's an auction and market. So if it's not competitive, if the APY underperforms what the VC thinks that they could get as the potential upside or in another opportunity, they just won't bid on it. You can in fact set that APY so high that you expect never to pay it, but you would have the right to buy some of it back if you somehow outperform it. And as long as that is high enough, the VCs will be fine with that. And there'll be a lot of other types of funds that are happy to get on board as well. The repurchase actually also assumes that, you know, someone like Sushi is going to have the cash capital or be able to finance the cash capital to rebuy the debt against the full bond in the first place. If they are taking out a fundraising of $60 million, it's because they don't have $60 million in assets to use in the first place. And so it's actually unlikely that they would be buying that out. So the VC actually gets the normal upside that they would expect in a regular token investment, but has the downside risk of getting bought back. So the main downside risk for them is this buyout at a lower percentage rate, but that still outperforms what they would normally get as an average per company, or they end up holding the tokens. And the tokens could go down, but the startup or DAO is defended against that because this isn't a type of loan that has a collateralization that's going to get called. So the worst case for them is that they pay out the tokens. Either way, it's most likely that the VC gets the tokens, but there's still this opportunity for the DAO to buy back, because if Sushi does 200x next year, they're obviously going to want to buy back a portion at least of that financing. And that would still be a great opportunity for any VC. So why is Smaug better overall for DAOs? It ensures tokens are locked, meaning there's no dilution today. That's a big deal. When we're talking about the amount in circulation, we can remember the Charizard cards, one locked today versus one not. It gives the opportunity for this buyback for some or all of the debt in order to share in the success rather than giving it all away to investors. As we said, you know, the VC bar for return is actually fairly low. If a VC is making a portfolio of entirely tokens, they don't necessarily need the 100x that they're used to in the traditional space. Especially if we see something like S bonds catch on, you're going to have a lot of funds who are happy to scoop that up and share in that upside. And it's also important to note there that most debt instruments are kind of like buyout fully or not, and this would allow Sushi to decide as they go along the term how much they're buying back and how much they're not. Because S bonds aren't privately negotiated deals with individual VCs, it forces the best term. One of the things we saw is like this deal was put forward with a number of private calls with VCs, each one advocating for their own type of valuation, their own metrics, their own lockups. If you have a few VCs involved, it's not a kind of market price negotiation. By opening this up and making VCs have to bid, or other types of funds and investors have to bid on what they want to purchase that bond for, you're ensuring you're getting the best price. They can also be auctioned using MISO and a whitelisting solution, so that Sushi is going to gain revenue from the offering, as well as other DAOs that aim to do the same. And you can create a private market for S bonds trading between funds and DAOs in a regulated way that's built on Sushi AMMs to drive more of that revenue back to Sushi. And many young projects are looking for treasury solutions like this, and if they use S bonds, they're more likely to use MISO, Sushi AMMs, provide LP incentives for onsen farming, things like that. So it becomes a kind of vertical offering suite from Sushi. What about Smaug and Bento? Because I mentioned you could probably build this as a BentoBox app. One of the largest opportunities here is definitely using that as a Bento app, because VCs and funds are sitting on a ton of idle capital, and S bonds are also going to have a large amount of capital posted inside them as collateral. If you have this in the BentoBox ecosystem, you'll be able to pull in that capital and allow the idle components to be used in those asset management strategies within Bento through partnership entities like Yearn. You'll probably have to have them slightly more restrictive than broad stream capital allocation strategies, because some of these are not in circulation technically, but it allows you to capture this massive amount of treasuries, because DAOs and VCs are holding hundreds of millions, if not billions, of treasury assets that are just idle. And the yield gained on those is a tremendous financial benefit to the ecosystem that can be captured by making this part of a BentoBox solution. Can we build Smaug? Yeah, Smaug's design needs some work. It was a first draft whipped up over a weekend. And I've invited any team that wants to partake and reach out to get involved. And we've had proposals so far from UMA and Ruler Protocol. UMA actually has already built a kind of first pass protocol in under a day of what an S bond might look like within the UMA protocol. And there's been a ton of interest from DAOs who want different types of treasury management. Sushi also has a model for debt instruments in Kashi so far that with some level of adaptation could probably build a Smaug-like product and power components of this. I haven't done a deep dive into the specifics of the Kashi contract, and I don't think it's quite fitting today, but it could easily get there. So building Smaug doesn't seem like it's too complex in terms of the implementation, so much as designing the right product features. I do think there's opportunities there, and I hope Sushi aims to capture them. If they don't, I'm still willing to work with other teams to help advise them down that path and hope that they build it on the Sushi ecosystem. But I think it's a tremendous amount of potential capital for Sushi to capture in the ecosystem and should be looked at carefully. Am I partaking in this round? No, not currently. Nobody has talked to me about that. If Mackie or the community felt I had a specific value add to the raise that is in line with the strategic partners that they want to have, I'd be happy to be involved. But only if I think the terms were fair and included the right risk model for Sushi. Otherwise, I'd abstain from that. But as it currently stands, I personally don't think that based on the strategic type of investors Mackie is looking for at this stage, which are primarily portfolio driven, that I'm the right fit for this round. So I'm not going to competitively throw my hat in the ring unless I hear otherwise, or that there's other value that either he or the community think I could add there. I was asked, do I think it's the right decision to raise? Yeah, I think if Sushi gets the right terms and they can prevent it from being too dilutive to the open market, and they can find ways to properly deal with the legal risk, then yes. There's a lopsided opportunity here. Like the upside opportunity of capturing the market that is before us in DeFi with generalized AMMs and other financial products is insane. And if Sushi doesn't capture that, somebody will. Sushi is in the running, right? They are already running that race. There's a lot of new startups who are trying to just get off the starting line. Sushi is already one of the competitive people moving towards that, and I think everything that they can do reasonably to keep that within their grasps and continue to pursue that should be looked at. Personally, my view is I wouldn't do a blanket open market sale. There are plenty of others who disagree with me on that. I also wouldn't do financial instruments that are too complex, that may be more geared towards financial funds than VC funds if Mackie is really looking for those strategic values, especially that portfolio ad. But I do think it's probably the right decision to raise. If Sushi didn't raise using Smaug, what would I suggest? My personal next preferences would be, I think having a separate Sushi Labs that is essentially granted a portion or part of or all of the treasury and does an equity raise against that entity is probably a good approach. We see a lot of DeFi products who have been built from the ground up with a company in mind do this. I think Compound has Compound Labs. Yeah, Uniswap probably has, is it Uniswap Labs or some other name? But they have a company attached that is contributing to the ecosystem and has been granted a locked allocation of treasury tokens because of their contributions. And the way that they're raising funds isn't actually through selling tokens, it's through selling equity in that entity. And so I think that's an opportunity here that can actually work nicely with the DAO model and still not present as much legal risk. But once again, I am not a lawyer. UMA's range token proposal, I think, is very strong. I think it's an interesting opportunity. I worry a little bit about the financial complexity of it. But I've chatted with the UMA team. They know what they're doing really well. And there's kind of agreement there that there's opportunities to look for a less complex version of it. I'll also say I was really critical of Arca's initial proposal. I think their new revised proposal with Lightspeed is much stronger. And I'm really impressed that they came to the table and did so many revisions around that to include other goals. And so while still personally it's not the approach I would take, I definitely applaud it and think it's much improved. I have no idea what the legal implications of that structure are. It's definitely something that would make me personally more nervous. And I think there are probably better opportunities in my view, but it's stronger for sure. So I think there are a number of opportunities for Sushi to pursue here that allow them to do this raise. And lastly, somebody asked, if Sushi didn't use Smaug, is it still worth building? Yeah, absolutely. I think treasury management and fundraising are probably multi-billion total addressable markets. And if it's not built on Sushi infrastructure, somebody else will build it. Sushi's ecosystem as it stands right now has this opportunity with Miso and Onsen to capture ecosystem partners at these really early stages when they're just starting out, when they're just trying to get users. And I think that's why a lot of these early launch projects look to Sushi, is because Sushi does have this kind of built-in audience and they can leverage that in partnership. And leveling them up into a later stage product like Smaug is great because they're already part of the Sushi ecosystem. Those late stage kind of fundraising partners get to be retained in the ecosystem. And I think they're often multiple orders of magnitude more lucrative just because of the scale of these sales. Like nobody's doing an initial Miso auction of 60 million in capital, but doing that as a late stage treasury diversity management thing, that's definitely something that's on the table. If Sushi doesn't pursue that, I'd likely try and support another team pushing it forward, as I think it's needed in the space. And I'd heavily advocate for it to be built on Sushi infrastructure. But that comes as less of a guarantee when Sushi's not at the table. And I think it depends on who picks it up and where it ends up going and kind of what it looks like in the end. I think there's a huge opportunity for Sushi, who's one of the best collaborators in the space, to work with multiple other protocols and kind of make this an industry standard rather than a standalone product that's built on the SushiSwap infrastructure and therefore capital capture within the Sushi ecosystem, but something that everybody else can get on board with. So I'd love to see them push that forward. So that's all the questions that I had, and I hope this was helpful to some people, even though it was long-winded, almost as bad as some of my Twitter threads. And if you have any other questions that I can help answer or put perspectives on, feel free to reach out. I look forward to seeing kind of what Sushi puts together, and I think there's great opportunities ahead of them. And I'm really impressed at the community as well as all the stakeholders who took the time to get involved. And there's a lot of VCs on that list that I didn't think we'd ever see forum posts from, but they actually took the time to get involved, negotiate, and consider the opportunity that was in front of them, as well as the needs and interests of the market. So I think that says a lot about where Sushi's at and where it's come from those first chaotic days that we all remember. And so I'm excited to see where it goes next.